All right. Welcome, everyone, to today's webinar. It's on housing affordability, and we are very excited. We have two wonderful guests, Rick Sharga and Valeria Esparza-Chavez. Rick is the founder and CEO of CJ Patrick Company, a market intelligence and advisory firm for companies in the real estate and mortgage industries. Rick is one of the country's most frequently quoted sources on the U.S. economy, real estate, mortgage, and foreclosure trends, and has appeared on CNBC, CBS News, NBC News, CNN, ABC News, Fox, Bloomberg, and NPR. It's quite a resume. As for Valeria, Valeria is the VP of Hispanic Segment Strategy Lead with Wells Fargo. As the Hispanic Segment Lead, Valeria partners across the business and with external stakeholders, advocacy groups, and industry trade associations to increase lending opportunities to Hispanic families across all income segments. We're very excited to have them both here. Valeria, we're going to take it to you to give some quick remarks.
Thank you so much, and good afternoon, good morning to everyone. I want to thank you for taking time to be here this morning and for being a part of AREAA, an extraordinary organization that works tirelessly every day to advance sustainable home ownership in the Asian American, Native Hawaiian, and Pacific Islander community. The goal of advancing home ownership in underserved communities to me is personal. I'm a proud daughter of immigrants and a first-generation American. My parents brought me to the United States when I was 9 months old. They left their home country at the age of 33 years old with 3 little children and less than $100 in their pocket, joining millions of immigrants who come to this country from across the globe with the hope to give their children a better life. To my parents, that meant giving their children educational opportunities that they never had and a home to call our own. And they did. My parents bought us a home when I was 13 years old. We all know that home ownership is fundamental to creating generational wealth, but the benefits are so much broader and profound. That house gave us security, stability, and a sense that we had made it in America. And it positioned us to attend better schools and enabled me and my 4 brothers and sisters the opportunity to become college graduates and business owners. Now, I want to thank you, AREAA, for leading us to continue working together to ensure that the road to home ownership reaches more of us, just like it was able to reach me and my 4 brothers and sisters and my parents. At Wells Fargo, we are committed to developing solutions to help close the homeownership gap and to contribute to a more inclusive housing system. This year, Wells Fargo made a strategic shift to place our focus on our own customers and diverse and underserved communities. We are so proud to collaborate closely with AREAA on the Housing Affordability Initiative that launched last year, with a focus on advancing sustainable homeownership, especially with first-time homebuyers and low to moderate income Asian American, Native Hawaiian, and Pacific Islander communities. Together and in collaboration across our industry, we can make progress and break down systemic barriers that make homeownership more difficult to attain. Thank you all, and I will hand it back to you, Jordan.
Thank you, Valeria. And yes, on behalf of AREAA, we are very lucky to have partnered with Wells Fargo and to have launched and worked together on this incredible housing affordability initiative. And part of that initiative, in addition to the many homebuyer fairs we've had across the country and the white paper that we produced, is putting out other educational content, such as this webinar. So without further ado, we will send it to you, Rick, to give a quick presentation on housing affordability.
Thank you, Jordan. If all goes well with technology, you should be seeing a presentation right now. Looks like we are. So we will get this thing up and running. I want to thank AREAA for inviting me to participate today, and I want to thank Wells Fargo, not just for being a sponsor of the event and of AREAA, but for the company's commitment to home ownership, particularly among underserved communities. It's one thing to talk about these kind of initiatives and to support them verbally, but Wells Fargo has always actually walked the walk and talked the talk, and so it's I think we should all acknowledge that as we discuss some of the challenges we're dealing with in terms of affordability across the country. We're going to cover a ton of information today in a very short period of time. These slides will be available for you after the webinar is over. So if we zoom past something, don't worry about that. You'll be able to get it later. And also there will be a Q&A session at the end. So feel free to enter some questions into the chat area as we go through this. We're going to talk about affordability, how we define affordability. We'll take a look at affordability levels, where they are today. We'll look at some of the more or less affordable areas across the country. Ask the difficult question about whether it's better for people to be renting right now in a low affordability environment. I will share some thoughts with you on why I think things might be getting better as we move forward, and then share some final thoughts before we wrap things up. Affordability, people often talk about affordability and really focus on home prices. And I wanted to point out that there are really three legs to the affordability stool. There's home prices, the obvious one. There are mortgage rates, which is certainly something that we've become very, very aware of in terms of the impact it has on affordability in the last couple of years. And there's also wage growth. And wage growth is often the overlooked aspect of home affordability. In two of these three categories, home buyers have had a real rough time over the last few years. Home prices have gone up over 40% nationally over the last few years. Mortgage rates effectively doubled in the space of about 6 months back in 2022 and have not come down materially since then. And wage growth, with a real brief exception coming out of the COVID pandemic, really hasn't kept pace with the rate of increases in home prices, and certainly hasn't been able to compensate for those increases in mortgage rates. Just to give you an historical perspective on the mortgage rate thing that we're talking about here, according to Freddie Mac, in the history of the country, as far back as they've tracked mortgages, we've never had mortgage rates double in a calendar year until 2022. And they doubled that year in, as I said, the space of 6 or 7 months, going from all-time lows back to up over 7 and almost 8% in some cases. So it's really had a massive impact on affordability for the average home buyer. This chart is hard to read because we're looking at one line being measured on the left and one being measured on the right. So you'll have to take my word for this, but what the chart actually shows is that wage growth is finally higher than the rate of inflation. So after a period of time when inflation peaked at over 9%, and wages were growing, but not growing fast enough to offset that, we're finally in a market right now where inflation rates are down below 3% on a year-over-year basis, and wage growth is probably up in the 4 and 5% year-over-year category. So again, the good news here is that wages, one of those three legs of the stool for affordability, are improving. And we're seeing that as a good news piece. On the bad news side, home price appreciation right now is continuing to outpace wage growth. They're getting closer, but if you look at home prices just in general prices, and this is a U.S. single-family home price index, it just depends on whose numbers you look at. In some cases, the median price we're seeing nationally is about $365,000. In this particular case, it's being noted at about $425,000. But in any case, you can see that those prices are going up faster than wages are going up. And if you looked at it on a percentage basis, and this is the Case-Shiller Home Price Index, you can see that again, the rate of home price appreciation continues to outpace wage growth. We have seen in recent months, and this really isn't reflected in these two charts, but we've seen in recent months that the average annual price increase has been slowing down. So we're still not seeing negative numbers in terms of price appreciation year over year, but we are starting to see those numbers slow down and get closer to wage growth. So over time, this should normalize itself. One of the fallacies in our business is people believe that when mortgage rates go up, home prices go down. And if you go back in history, that really honestly hasn't been the case. What's really been the case is that home price appreciation has slowed down as mortgage rates have gone up. We did have, according to some studies, NAR did one that showed at one point home prices had gone down year over year in 2022, but they immediately rebounded and started to come back up. But the bottom line here, regardless of whose numbers you're looking at, when you see mortgage rates going up, and that's the gray line you're looking at on the chart, we didn't see that fall off in home prices. We never saw them go net negative according to most national reports. So again, what we have seen is a slowdown in the rate of appreciation. And if mortgage rates start to come back down into more normal levels, if home price appreciation slows down and if wage growth continues to go up, over a period of time, affordability will improve. But the key phrase there is over a period of time. This is not something that's going to be fixed overnight. According to the Atlanta Fed, and that's where I'm getting some of the affordability information we're sharing today, all of the drivers of affordability have combined to make affordability as really about as bad as it's been in many decades. We see the red area there, which is mortgage rate changes. The higher the mortgage rates went up, the less affordable properties became. The higher home prices got, the less affordable properties became. And wage growth, which is the green area, which is positive, hasn't been enough to offset those two negative criteria. So you can see how quickly affordability dropped. And in fact, right now, affordability, as I mentioned, is at its worst level in decades. This is the monthly index that the Atlanta Federal Reserve publishes. And I'll have a website address for you if you want to check this out on your own afterwards. But they create an index which says that anything at 100 or over indicates good affordability. Anything at 99 or lower suggests weak affordability. And as you can see on the chart, right now we're looking at affordability levels of about a 63 criteria, 68.3. Very, very low. Not the lowest it's ever been, but very, very close to the lowest it's ever been. And if you were to take this affordability chart all the way back years and years, we haven't seen affordability this weak really since the 1980s. If you look at what happened when mortgage rates skyrocketed, we saw that affordability actually declined at the fastest rate ever. So even if you went back to the 80s, it was more of a gradual decline in affordability. But we went through a period, a very unusual period coming out of COVID, where mortgage rates were at the lowest levels ever. It pulled forward a lot of demand, a lot of home buying activity. So we had more buyers on the market, which created more competition for the available inventory, which drove prices up dramatically. We had a lot of people moving from high-priced areas into lower-priced areas where they would pay top dollar on the homes that they bought, sometimes paying over local market prices. So you had a market like Boise where home prices went up 47% in 1 year, which is just crazy. And while these prices were going up, the Federal Reserve started raising the Fed funds rate. We saw mortgage rates skyrocket in a very short period of time, and that's why the affordability fell off a cliff. So really unusual set of circumstances going from rapidly accelerating home prices to rapidly accelerating mortgage rates, which caused rapidly deteriorating affordability levels. And that's going to take us a little while to dig out of. If you're going to look at areas that are more or less affordable, the Los Angeles metropolitan area is not the most expensive market in the country, but it is the least affordable. So according to the Atlanta Fed, if somebody's making a median wage across the country and they buy a median priced home, it takes them about 44% of their income to buy that home. Their affordability threshold is about 30% of that income. So across the country, the Atlanta Fed is saying basically nothing is really all that affordable right now. But if you're in the Los Angeles metro, it takes you about 88% of your income to buy a home. So just crazy on affordability in a market like LA. And that's why, unsurprisingly, we see a very low home ownership rate in the Los Angeles area. The Fed breaks the numbers down even a little bit more. So if you're going to look at a couple different ways of analyzing this, you remember that the affordability index is 100. You remember nationally, we were at 68.3%, the number I was goofing up before. The LA Metro is at 32.6%. So just a crazy, crazy low level of affordability. Markets in California, markets like the New York Metro, Washington, D.C., Hawaii, very often are lower than the rest of the national average in terms of affordability. But this is about as low as it gets. And you can see on the left-hand side here what the Atlanta Fed does is break out the counties that comprise the metropolitan area, and you can see that both of the main counties that make up the LA Metro have very, very low affordability levels. On the other hand, if you want to go to the most affordable metro in the country, you need to move to Ohio, and specifically to the Dayton metropolitan area, where it takes 28.2% of that median wage to buy a median priced home, significantly lower than the national average and well below what we're seeing in markets like Los Angeles. So there are a handful of markets across the country. We'll talk about that in another slide or two that are considered to be still affordable by the Atlanta Fed's Metro. And it's important not to kind of lump everything into this is what's going on in the entire metro area. I picked Pittsburgh because I knew it was one of the more affordable areas in the country. And if you look at the 6 counties that make up the Pittsburgh metro area, you can see that 3 of them are considered to be actually very affordable, and the other 3 are mildly unaffordable. So it's important when you're looking at a local market to understand, which part of the local market you're dealing with. It's not enough to say not enough to cover the whole metro area with a blanket. There are typically pockets that are more affordable or less affordable in just about every region. And if you're interested in looking at this kind of data to find out what's going on in your market, the Atlanta Fed publishes this data. It's available for free. This is the web address you can go to. It's the atlantafed.org Center for Housing and Policy Data. You can take a screen capture of this or take a look at it. But on this website, you'd be able to find their national affordability numbers, the national versus metro area ratings, and then even this metro and county affordability analysis. And it's a great website to be able to take a look at what's going on in your market. If you have a buyer who's looking to move into the area or looking for more affordable parts of the same area, it's a great tool to be able to see, what it's taking in terms of that buyer's income to be able to sell a property. Also, probably will give you some insights in terms of how to price properties that you're listing for sale, because that's another way of using this data. On that same website, they rank metro areas with populations of 500,000 or more, from the most to the least affordable. And if you looked at all of the hundreds of metro areas they have listed here, there are only 4 that are actually above that affordability index of 100. 3 of them, ironically enough, happen to be in Ohio. And one that's just outside of those top 4 is Pittsburgh. And I'm from the eastern part of Pennsylvania originally. We always kind of thought Pittsburgh was part of Ohio anyway, so it makes sense that it's included there. But you can see on the map, anywhere that's green is likely to be more affordable than not. Anywhere that's sort of that peach or salmon color is less affordable. And you can see that pretty much anywhere you go in the country, most of the markets are considered to be relatively low affordability. That's just the market that we're in right now, because of those events that have happened that I talked about earlier. My friends at Adam put out an affordability map on a quarterly basis. They're showing pretty much the same thing. Their criteria is a little bit more strict than the Atlanta Fed. They look at affordability as being capped at 28% of your income. And based on that criteria, that threshold, 99% of the areas that they covered in their most recent report are less affordable than they are historically speaking. And the majority of metros, as you can see on the map, are considered to be unaffordable. NAR publishes similar data. And I apologize, I noticed that the headers on this got wiped out. But in their most recent quarterly report on affordability, they showed that the only region in the country that they considered to be affordable was the Midwest. It had an index rating of 119.2, so same sort of criteria here. Anything at 100 or above is affordable, 99 or below is less affordable. The South was close. It was at 97.9 and actually showed a slightly improving level of affordability, whereas the Western region and the Northeast region both showed very, very low levels of affordability. So probably not a surprise that we're continuing to see a migration of population from the coasts, specifically from the Pacific region, and to a certain extent from markets like New York and Chicago into more affordable sections of the country. I tell people that, anecdotally, you have coffee table discussions or kitchen table discussions about this in your household. I have an adult son who's getting married next month. He's a teacher. His fiance is a lawyer. And they asked me recently what states they should be looking to outside of California so that they should be considering to move to so they can eventually afford to buy a house. And when the median home in Southern California is selling for $850,000, you can imagine that young couples, young professionals starting out just are really up against it when it comes to affordability. And so we continue to see a migration into more affordable parts of the country. I mentioned first-time buyers being up against it, and the market is even less affordable for first-time buyers. Typically, their incomes haven't jumped as high as it is for move-up buyers who've had longer careers at that point in time. They typically don't have the equity they need. And if you look at the very last line on here, I did something to really kind of give you a handle on how difficult things have become for buyers. The first-time buyer median income right now across the country is $66,560. But in order to qualify to be able to actually buy a property, median price property, their qualifying income would need to be $106,464. So their affordability index is very, very low at 62.5. And that's just what first-time buyers are up against as they try and enter the marketplace. And again, all this data is going to be available on the slides, so hopefully you'll be able to make some use of it. Something that you might be seeing as you're talking to buyers and even to some of your sellers is that insurance rates have jumped up significantly over the last couple of years. It's a hidden affordability issue, but it's becoming more and more of a problem. And you can see parts of the country like Louisiana and Florida, even Oklahoma, parts of the country where we've seen an increase in the number and severity of extreme weather events. And insurance losses have been measured in the billions of dollars. We're seeing insurance premiums jump up very, very significantly in those markets. And it's not isolated to just those states. We're seeing the South and Southwest start to get hit. Texas, as it turns out, is the part of the country that has the most severe hail events, according to some data from Verisk. And those hail events, again, we're talking about hailstones of over an inch in diameter, big hailstones causing billions of dollars of damage as they hit houses. California insurance rates will start to go up more significantly. The state is seeing insurers leave the state because state regulators won't let them raise premiums high enough to offset their losses. So they're just cutting bait and leaving the state. In order to get them back in, the state insurance commissioner is going to have to loosen the strings a little bit, which is going to cause those prices to go up. Speaking as a California homeowner, I can tell you that today I'm paying twice what I paid 4 years ago. And my insurer last year tried to double those rates. So I switched insurers, but only so many times you can do that. So it does become an issue that's not factored into that normal home cost, mortgage rate, and wage triumvirate that I mentioned earlier. Something to keep an eye on as you're helping people figure out what they can afford to buy or how to price their home to make it affordable if somebody's going to be looking at huge insurance premiums. Keep an eye on property taxes as well. I didn't include that in today's discussion, but they've been going up quite a bit. For some buyers, prospective buyers, the short-term answer might be renting. The average rent across the country right now is a little over $2,000. That's a little bit of a misleading number because it's a combined number of single bedroom, 2-bedroom, and 3-bedroom apartments. But be that as it may, we saw rent rates go up significantly from 2021 to 2022. Since then, they've actually stabilized. They pretty much flattened everywhere across the country right now. They're going up a little bit in some markets, actually going down a little bit in some markets. But according to recently published studies, for most counties, almost every county in the country right now, your out-of-pocket rent payment is lower than your out-of-pocket mortgage payment would be on a similar kind of building. And in fact, the rent-to-income ratios have been coming down. So rental rates are going up at a much slower pace than wages are. So where we mentioned earlier that according to the Atlanta Fed, it takes almost 44% of median wages to get that median priced home. It's only about 22% of wages on average to be able to afford a rent. So short term for some buyers, for some prospective buyers, might be a better decision to rent for the time being while we're waiting for market conditions to improve, home prices to slow down, mortgage rates to come down a little bit, and they can save more money for down payments. I apologize in advance for this chart. It's impossible to read. I realize that, but I wanted a graphic that showed that home ownership, and Valeria mentioned this earlier about its contribution to generational wealth and financial stability. In most markets, even in some of the higher priced markets, which may surprise people, in the long run, and sometimes even in the short run, it's still a better financial decision for families to own than to rent. Even if you're paying a little bit more in your monthly payments to be able to make that mortgage payment, pay for maintenance and taxes and the like, that's offset by the amount of equity that you're building. And today, there's a record level of homeowner equity, over $34 trillion in homeowner equity across the country, which just really does go to show the power of home ownership over time. So if people can't afford to get through this short-term affordability issue, in most cases, it's still much better for them to buy than to rent. One of the keys, we're depending on whose numbers you believe, anywhere from 1.5 million units too low in terms of homes that are available to as many as 3 million. And that just depends on who's doing the analysis. But First American's done some recent analysis of markets where we're seeing inventory growth. And what this chart is saying basically is that where we're seeing more inventory growth, we are seeing home price appreciation slow down, and in some cases, actually reverse and go slightly negative. So markets like Austin, which probably had home prices escalate too rapidly. It got a little bit overbuilt as builders got excited about opportunities there. We're starting to see home prices actually reverse course. So one of the keys to better affordability is more inventory, and that's not likely to come from existing homeowners until we see mortgage rates come back down into the 5s, because over 3/4 of homeowners still have a mortgage rate of 5% or less. So until we get mortgage rates that are closer to what those current homeowners are paying today, the idea of trading in a 4% mortgage for a 7% mortgage means that homeowner would wind up doubling their mortgage payment every month, which is something most people simply can't afford to do. So we're going to see people who need to move list their properties. They got a new job, or they got laid off, they got married, they got divorced, there was a death in the family, there was a birth in the family, there was a job transfer. Those are the kind of properties we're still seeing come to market. Some downsizing from baby boomers who are aging out. But again, it's not going to be a huge influx of new homes coming to market. Inventory is up 40% from a year ago, but we're still at about half of the number we were in 2019. A little bit better than half right now. We probably have about a 4-month supply of homes available for sale, as opposed to 6 months, which represents a more balanced market. And inventory is recovering unevenly across the country. There are only 4 states right now where inventory levels are higher than they were in 2019. Texas, Idaho, Tennessee, and Florida. And I'll show you in another slide or two that those are markets where we're seeing home prices slow down and in some cases actually go negative. But other parts of the country, we're just not seeing the recovery in terms of inventory. And new listings are only up about 5% year over year. So if inventory is up 40%, but new listings are only up 5%, what that tells us is the volume of sales has slowed down and properties are staying in inventory longer rather than getting listed and getting sold right away. And that's one of the reasons we're seeing inventory numbers go up. But again, if you were to look at a slightly different way of analyzing this, inventory levels that have gone up in the last year, so dark green is where we're seeing inventory levels come up the most, and the yellow and light green less so. And then compare that to the chart on the right where we're seeing home prices on a year-over-year basis or a month-over-month basis. In this case, you can see a market like Florida where inventory is up 70% year over year, where just about none of the markets are actually showing home price increases. They're either flat or declining slightly. Similar things going on in Texas, similar things going on in most of Arizona. So the hope is that as we move forward, we'll see inventory levels increase. That's also true in the new home market, where for most of the country, on average, you're seeing home prices up 3% year over year. But in Texas, the market is flat. In Florida, we're actually at slightly negative year over year home price appreciation. So again, there's some hope that home price appreciation will slow down as inventory comes up. The other thing that's a metric to look at is list price reductions. In a normal market, on average, you're looking at about a third of all homes getting a reduction before they're sold in their list price. Right now, we're close to 40%, but it does appear to be slowing down at a time of year when we usually see list price reductions go up. And it looks like it's starting to flatten out. It is very likely that with the slight decrease we've seen in mortgage rates lately, down to about 6.5%, we will stop seeing list price reductions at this level because those mortgage reductions will probably bring more buyers to the market. Certainly won't bring a lot more sellers to the market because the delta is still too big between current mortgage rate and that higher mortgage rate. But as you get more buyers to market, there's again more competition for properties available for sale, which means that it's less likely to see list price reductions. So what is the general consensus in terms of home price appreciation? Well, it's kind of all over the map, but according to this survey, which I'm lucky enough to be one of the panelists in, the basic consensus is a return to more normal levels of home price appreciation. The consensus this year in 2024 is that when we get to the end of the year, home prices will have gone up a little bit more than 4%. Then add another 3% to that next year and so forth and so on. So steady increases, but not the kind of crazy increases we saw a couple of years ago. And in fact, if you look at the overall, and I'll just jump past this slide. If you look at the consensus numbers for annual growth over the next 5 years, it's at about 3.8% over the next few years. And even the most optimistic people, we're looking at home price appreciation is averaging about 6% over the next few years. At 6%, we'd be running a little higher than the rate of wage growth, but at 3.8%, we'd actually be lower than wage growth. So the hope here is that the consensus is right and home prices will continue to rise at rates lower than wage growth. The other factor, of course, is mortgage rates. The Mortgage Bankers Association are calling for that 30-year rate to gradually slow down over the next couple of years and get back down into the fives in 2025 and 2026. The Fannie Mae forecast, its most recent forecast, is similar, getting down into the low sixes as we go through next year, and then below that as we go further on. And I will say that I expect both of these forecasters to revise their forecasts because I believe mortgage rates have already come down a little faster than what they expected. And it's very likely that we're going to see the Federal Reserve reduce its Fed funds rate a couple times before the end of the year, which could have a material effect ultimately on mortgage rates. We can have a whole webinar on mortgage rates. We can do that later, but for the sake of brevity, getting through this, let's wrap up. Just to recap some of the stuff that we talked about, soaring home price appreciation and mortgage rates over the last few years have outpaced wage growth. We've had a huge deterioration in affordability, and it's the worst affordability in recent record. However, wage growth is now starting to outpace home price growth. And over time, if nothing else bad happens, the market should be able to rebalance. Inventory is really the key to prices stabilizing. We could have an affordability that gets worse short term because of those slightly lower mortgage rates, but over the next couple of years, that should balance out. As mortgage rates, which are now down a full point from recent highs, are likely to continue to decline slowly. The market has already built in some Fed rate cuts, and so that's important to keep in mind. When they announce a rate cut next month, I don't expect mortgage rates to immediately fall off a cliff. And if you're working with investors who, by the way, make up about 30% of all residential home sales today, they can use this data to their advantage, much like you can as real estate professionals. They can target more affordable markets for their purchase activities, particularly if they're going to fix and flip properties. And we're seeing a lot of investors move to buy rental properties in some of those less affordable markets for prospective buyers who have been temporarily priced out of the market. That wraps up my prepared comments. Got through that as quickly as I could. I hope didn't overwhelm you with too much data, and we'll stop sharing my screen now to see what Jordan would like to add and if there are any questions coming from the group.
Thank you, Rick. Yes, please, anyone watching, if you have any questions, again, now is a great time to ask them, and we'll do our best to answer them. So now what I want to do is I'm going to give a quick presentation and really connect a lot of these trends that Rick shared regarding housing affordability to the AAA and HPI community. Why at AREAA is it so critical for us to be involved in this initiative? So allow me to share my screen really quick. All right. So first I wanted to bring up this map. This is from Freddie Mac and it was in the State of Asia America report 2 issues ago. And it shows where are the mortgage-ready Asians located around the country. You can see from this heat map that the darker orange color indicates a higher amount of mortgage-ready individuals, and those purple dots are a sign of low affordability. So you can take a look at this map, and this sort of gives you an idea of where potential home buyers are within the Asian American community. And then you can go to this map that Rick shared earlier showing metro area home affordability. And what you can see is that these maps look quite similar when you go back and forth, which shows that, again, I think we get this question a lot at AREAA for, when you look at the AAA and HPI income, it's certainly above the national average. So why is that an issue that we should care about? This is why, because high income does not necessarily indicate ease when purchasing a home. Next, I wanted to talk a little bit about supply. This is from a slide deck that was presented at our Diversity Fair Housing Summit by the National Association of Home Builders. Again, I think I wanted to address the sort of comments on, okay, if we have an inventory shortage, why aren't people just building more? These are some of the big barriers that the National Association of Home Builders has mentioned. So cost/availability of labor, building material prices, availability of developed lots. Those are the top 3 points. And those are not expected to dramatically change in the near future. So again, affordability is going to continue to be very important for us as things go forward. Next, I wanted to just really quickly touch on a trend that we've seen that is pertinent to housing affordability, and we've seen rise across the country, and that is multi-generational housing. AAA and HPIs live in multi-generational households at a rate of 27%, which is 8%, so significantly higher than the US national average of 19%. But as you can see, since the 1970s, this has been a rising trend across the country, across all demographics. And we are expecting that to continue to grow and potentially be a solution or trend as a result of low housing affordability and also greater housing demand among boomers. I'll go from there. Next, I wanted to touch on the Housing Affordability White Paper. This is the part of our initiative that we did with Wells Fargo. the goal of this white paper was to look at certain trends, certain solutions within housing affordability, and see what can we as real estate practitioners do. And I'm going to actually go into the white paper itself. All right, you can all see that. So yeah, going into the housing affordability white paper, one of the things we wanted to do in here is take a look at certain solutions that people have recommended or new trends that people are talking about. You know, when we go to conventions, when we attend webinars, we always hear about, you know, what are some new trends, what are some innovations that can sort of shift the market. And these are not always going to be industry-wide solutions on the macro scale, but on the micro scale, it's very important to know about these things because this could be a solution for one particular client. And for that individual, that can be the difference between being able to afford or not being able to afford. So again, we provide an analysis on modular homes, providing benefits such as cost efficiency, quality control, flexibility, and scalability. With the limitation of financing barriers, they're often much more difficult to finance, and also limitations on size, shape, and novelty. Some of the other things we looked into were tiny homes and ADUs. These are, again, sort of trends that we've heard talked about. ADUs in particular, I think we've seen a lot of excitement, a lot of headlines regarding them about how they can A, aid in multi-generational housing, and B, be an affordability solution. But again, there's limitations that we have to consider. For example, raising property taxes or regulations that are barriers for that as well. Moving forward, we took a look at accessibility, down payment assistance programs, expanded financing solutions. We partnered with Freddie Mac in addition to Wells Fargo on this, but Valeria, you may have more information on this after, but yeah, financing and removing financing barriers and making sure that those are accessible for minority and marginalized communities is going to be very important as affordability continues to be an issue. And lastly, in this white paper, we took a look at equity. One of the big factors we analyzed was the difference between communities of color and white neighborhoods relative to the mean appraised value. Basically, one of the big issues that we've seen is with regards to appraisals, that there are disparities in terms of home valuations. And from an advocacy standpoint, that's something AREAA continues to look at when you think about wealth creation within minority communities. And lastly, to wrap things up, a quick look at inclusive housing policies and targeted investment in underserved areas. These are, again, things that from an advocacy standpoint, whether it's on a local or federal level, it really underscores the importance of our policy and advocacy work with AREAA, and also the importance of why we work with our partners and sponsors across so many different groups to make these initiatives happen. So that's just a quick sort of analysis on why affordability is important to us and what we can do about it. So that's all I really have to share. Valeria or Rick, any closing thoughts before we see if there's any Q&A? All right, well, I guess that wraps it up. Thank you all for attending and watching this webinar. Thank you again, Valeria and Rick, for joining us and sharing your valuable insights. And yeah, we hope to talk more soon. Have a wonderful day, everyone.
Thank you.